Hey yo, how's it crackin' with my people, the daily faithfuls of the Chico barracks, and if you're new, you haven't earned your stripes, you're just a viewer of the tube. My name is Tyler, and this crypto channel is about to start in 10, 9, 8, 7, 6, 5, 4, 3, 2, 1, and 0. It's time for Chico Crypto. And the timeline is working itself out like a Broadway play. We are turning the monthly pages into September, only 2 months away from one of the most turbulent market events in the history of my life, the presidential election of 2020, the Bitester versus the Trumpster. But the more I research into what is going on, the more I realize this is just all a smokescreen to loot the American public from either side, the Democrats or the Republicans. Let me try and explain. While this world has been distracted, those in power in this country have been pushing for sweeping changes to retirements of Americans, aka 401ks. What are the changes? Well, the Department of Labor at the beginning of June announced they wanted to change the 401k rule, which stopped these employee-sponsored retirement plans from having portfolios which contain private equity investments from firms like Fidelity, Vanguard, and of course Blackrock. Now this is throwing these retirement age investors to the wolves, the literal wolves of Wall Street, where risk is an afterthought to these guys, especially Blackrock and CEO Larry Fink, who is running the government's corporate credit facilities in collaboration with the Treasury and the Fed, initiated to save our economy. Blackrock, with the government facilities, has been given the power to quarterback an unprecedented amount of money, $750 billion to leverage in the corporate bond buying program, which includes both investment grade and those junk bonds. So our government already gave a certain private equity firm money, the most ever handed to a firm like this in the history of our country. And that's coming out of our taxpayers' pockets. And now they're attempting to get access to even more money from one of the only things the general American public gets that is tax deferred. 401ks. Now, if you didn't know, it's a place where the average American, based on statistical numbers, stores the largest majority of their wealth. It's the place, since their inception in the late 70s, that have become a core part of the American dream. Our citizens have put all their eggs into one basket, the supposed safe place to retire, as 401ks in the past used mutual funds, bank collective investment trusts, and insurance company pooled accounts whose portfolios were the focus on publicly traded stocks and bonds, and usually extremely low risk. But private equity vehicles and investments are extremely high risk, usually a fund which is a portfolio of privately held, usually struggling companies, and the fund's goal is to rehabilitate or liquidate them, enriching the passive limited partners and the general partners, including those managing the fund. Now, direct investments as a limited or general partner is usually restricted to high net worth individuals, as these individuals are in a better position to take on the massive risk that comes with these, and the astronomical fees charged by them. But these high net worth individuals have stopped pouring money into this market. It's literally dried up to desert proportions in the past 8 months. Let me show you why. Here is a list of the 113 companies that have filed for bankruptcy throughout the year. Big names I'm sure many of you recognize: Fairway, Pier 1, True Religion, JCPenney, J.Crew, Hertz, 24 Hour Fitness, GNC, Lucky Brand, and more. Now, CB Insights also has this listed, and let's just search by the term private equity in their list of companies. It comes up 17 different times. Neiman Marcus, private equity company saddled the company with debt. Private equity bought it. Private equity, and private equity again. So a place where these firms get their money, high net worth individuals, they notice this and they ain't going to be putting their money in a fund house of cards on the brink of collapse. For example, Wally Ockby, senior analyst at 8 Wealth Management Group, stated the pool of available capital from high net worth investors for private equity has recently dried up. They're looking for cash anywhere they can get it. Therefore, they go to 401ks, where investors typically don't understand what they're investing into. So back to 401ks. There is a lot of cash and value locked up with American 401ks. The 401k marketplace is $8.9 trillion, or just 42% of America's $21 trillion GDP. It's massive, and if this gets finalized, the rule to bring in private equity, and it looks like it just might, you know who's gonna go wild like a raging party that goes until 5 a.m.? Wall Street, and of course those private equity firms. Who is Wall Street? And those in charge want to get it passed before election time, because like I mentioned, the clock is ticking to a turbulent market event, the November election. And now it's time to explain why it doesn't matter what happens. It will all be the same, turbulence or not. As we know, the Trump administration chose Blackrock to be its helping hand. Well, if you've watched my channel for any amount of time, you know so did Obama. They contracted Fink and Blackrock to help with the 2008 financial crisis, and Fink was originally brought on by George H.W. Bush. Well, the other person who could win, the Bidester, he is going to pick Blackrock too. The Campaign for Accountability covered it. Middle-class Joe Biden courts Wall Street oligarch Blackrock's Larry Fink. Their article states, in January, The Atlantic reported Biden went to see Fink, who told the ex-vice president, "I'm here to help," which Biden took as a sign that Fink wanted a role in his campaign, assuming he runs. Which we all know he did run, and then the New Republic covered it further. Their article states, an even more full-throated merger of Blackrock and the state could be on the horizon, as CEO Larry Fink cozies up to Joe Biden's presidential campaign, likely angling for a top cabinet post. Whatever the result of the November election, Blackrock is poised to come out a winner. And then CNBC seals the deal in their article titled, Biden Donors Privately Float Big Names, including Elizabeth Warren and Larry Fink, for key roles. So whatever happens, Trump wins, Biden brings home the bacon, Wall Street will continue to be pumped to beyond proportions, as Fink is in the driver's seat, no matter what. So I know I predicted another market collapse come November, and it's still very likely a big one, but it won't be an apocalypse type scenario, like I once thought. I should have known no matter the outcome, Blackrock would be controlling the economic strings. But I didn't realize they were already a shoo-in with Biden. So this is what's going to happen in my own opinion. Trickle-down economics at their finest. Now the stock market is much bigger than the crypto markets. Latest data taken at the end of June puts the US stock market worth over $35 trillion. As of yesterday, the crypto markets were just over $380 billion, or just 1.08% of the behemoth that is Finance 1.0. Now, private equity firms and their investors, their money is tied up in the behemoth. And with the news of the 401ks, this behemoth will keep growing larger. But so will the crypto markets. Why? I wonder if Blackrock is eyeing the tiny market. Well, why did they tweet this in September of 2019, last year, praising blockchain and having a blockchain lead, Robbie Michinik? Now, let's just take a look at the top private equity firms. Number one on the list is, of course, Blackstone. No, not Blackrock, but Blackstone, ran by Steve Schwartzman. Steve is the one who gave Blackrock the initial capital to get going. Larry Fink used to work for Steve, and the name for Blackrock was thought of by the two. So Blackstone, what's their thoughts on crypto or blockchain? Well, Steve in September of 2019 said this regarding blockchain. There is all kinds of uses you can have from certain executions. Blockchain technology is a very good idea, and it will end up being adopted because it's good technology. Applying it to the creation of money is sort of, for my taste, pretty odd. He was asked by the reporter, so in the future, do you see Blackstone investing in companies that are using blockchain technology? And he replied, that would be good, because it's a sound, very interesting technology. Okay, that's just one, the most powerful and biggest, but it doesn't mean the trend for these firms is going the way of blockchain and crypto, right? Well, number two is Carlyle Group, and guess what? Just in February of this year, he joined the advisory board for a blockchain payment startup called RadPay. Okay, just two out of the top. How about number three? Well, according to that list, that is KKR Inc. and Company company. And guess what? In June of last year, the co-founder Henry Kravis invested in a crypto fund, a flagship one to boot, Parify Capital out of San Francisco. How about number 4? They can't be going blockchain too, right? Well, that is TPG Capital, and of course they are. Their venture wing, TPG Growth, just a few months ago in April, led the $100 million funding round for the blockchain and AI-based identity platform on Fido. Now, the more capital access these guys get, the more risque things they put their money into, like blockchain and crypto. It's good short-term for the crypto markets, but not good for the system overall and long-term. I've explained it 100 times, so I'm not going to explain it again. But the leverage game these guys are playing eventually comes to an abrupt end. And when it does, yikes. This year, next year, down the road in 2023, 2024. I don't know, no one knows. But hopefully you, me, and our wealth survives as we hold on to the assets of the future. Cheers, I'll see you next time.